Hi, folks. Welcome to today's Bob Binney Wealth Management webinar. We're glad you're here, and we hope to share some information with you that'll be helpful for you this year. What are we going to talk about, Jesse?
5 strategies for efficient gifting and legacy building. And before we get started, if you have any questions while we're going through all this, we'll address them at the end. And there's a box on the bottom of your screen you can click and you can type those in. So to get started, like I said, our title is 5 strategies for efficient gifting and legacy building. So we're going to be talking about 2 types of gifting. The efficient gifting, the gifting part is going to be giving while you're living, and the legacy building part is going to be leaving a legacy after you're gone. And when we're talking about efficient giving, what we're talking about is when you want to give to a cause that you care about or someone you care about, you want to give as much of that money as possible to them. You don't plan to give or want to give a portion of that money to the government in taxes. And so when we're talking about efficient giving, we're talking about how to do that and leave the government out of it as much as possible.
That's right. And, when we're talking about giving while you're living versus giving in your estate or after you pass on, it reminds me of my great aunt Evelyn. I guess it'd be your great aunt Evelyn, who's long gone, but she always used to say she wanted to give her giving while she's living. And so anyway, thank you, Aunt Evelyn. And this has to do partly with the tax changes that happened in the Trump near the end of the Trump administration, I think 2019, where they raised the standard deduction. And raising the standard deduction is good, but it made it so that many people, many of our clients, many people we know, don't get to itemize anymore. And so if you don't get to itemize a charitable contribution, you don't get to deduct off your taxes. And so that's what some of this is about, is because of the changes in the tax laws regarding the standard deduction and not being able to itemize. So strategy, we didn't show the overview, or did we show the overview?
We will show the overview at the end.
Oh, we'll show the overview at the end. It'd be the end view, but let's show them the first one. So strategy number 1 is called qualified charitable distributions. Qualified charitable distributions. And that has to do with giving while you're living, obviously, to charities. So the idea of a qualified charitable distribution is making a charitable contribution directly from your IRA rather than from your bank account. Rather than taking the money out of your IRA, maybe because you're retired and you're having to take required minimum distributions, and then put it in your checking account or whatever and writing a check to a church or to a charity. If you go directly from the IRA, you don't have to pay any taxes on that distribution. Now, there's some rules. One is you have to be over 70 and a half in order to be able to do this, to take money, send money directly from your IRA to your charity. And if you have an IRA with us, we can do that for you. You just got to tell us some information on the charity and how much you want to give, and it'll go. Now, please don't, if you want to do this before the end of the year, please don't wait until the end of the year to do it. Please let our office know, particularly Lori does this, and we can get it done for you before the end of the year. So the first rule of thumb to know of is you have, in order to make a tax-free distribution from an IRA to a charity, you have to be 70 and a half. The second one is the maximum you can give is $100,000 per year. But that's not probably going to be a problem for most people. But anyway, also, this is a cool thing. It can take care of all of or part of your required minimum distribution. So let's say that you have a RMD because you're over 72 now. That's the rule for the RMD. Let's say you're 75 and your required minimum distribution you have to take is $5,000. If you want to, you could have that directly go to a charity and you don't have to pay taxes on it. So instead of writing a check out of your account to give $5,000 at the end of the year to your church or to a charity. You could have it go directly out of the IRA and not have to pay any taxes on it.
And this is something we have a lot of people do, because you have to take that RMD money out every year, but some people don't need that as their income. So they don't want to have to pay taxes on income they don't need. So instead they have it go directly to a charity or their
Right.
church or whatever.
So they still get a 1099, correct, Jess?
You are still going to get a 1099 showing that you made a withdrawal from your IRA. And when you get that 1099, it's not going to say that it was a qualified charitable contribution for your tax purposes. It's going to look like it was a withdrawal. So the way that you make sure that you don't have to pay taxes on it is you tell your tax person that you sent that directly to a charity as a qualified charitable contribution. Or if you do your taxes yourself, there'll be a question on there as you're going through of whether or not you made any charitable contributions, things like that.
Right. So if you have any questions about that, let us know.
So moving on to strategy number 2, it's kind of related to strategy number 1 in that it has to do with your IRA. And strategy number 2 is making a charity a beneficiary or the beneficiary of your IRA. And this is part of leaving a legacy
Right.
when you pass away.
So we've had this occur with some clients recently, and this is why we're kind of thinking about it. So let's say that you're setting up your estate plan and you want to leave a certain amount of money or a certain percentage of your estate to charity. Great, good for you. But if you give let's say that you're going to give some of your money, most of your money, maybe to your kids and family, and a lesser or a certain amount to charity, say 10% or $10,000 or 50 or whatever. If that money to your kids goes from your IRA, they're going to have to pay taxes on it. Maybe not immediately, but they have 10 years with which to take it out and pay the taxes on it. If the money goes to a charity, nobody has to pay taxes on it. So let's say that you wanted to leave $50,000 to your church. You could, in your estate plan, your trust or your will, you could say, it goes to my 3 kids, but I also want $50,000 to go to my church. Well, and then maybe you have in your IRA, the beneficiaries of your IRA are your kids. Well, your kids got to pay taxes on that money when they take it out. Instead, what you would want to do in that situation is make the charity get their money from the IRA after you're gone, that they get that $50,000 from your IRA and nobody has to pay any taxes on it. And then your kids get their money from your regular estate, which they don't have to pay taxes on maybe any of that money, because most of that money, your cost basis, your tax basis on it gets stepped up on your debt.
And we'll kind of talk about that in a little bit more detail here a
Yeah.
little bit later. So moving on to strategy number 3.
So strategy number 3 is we're calling it donor advised funds, and we're going to explain what a donor advised fund is. It can be part of leaving a legacy, and it can be part of giving while you're living. So a donor advised fund, there are a number of these set up across the country, and the one we use usually is called American Endowment Fund. And you can create an American Endowment Foundation, that's right. But you can create an account with them and call it, I could call it the Bob and Angela Benny Charitable Foundation. And it's set up with the American Endowment Foundation. And I can put a certain amount of money in there this year or anytime. I can do it every year. But say I put whatever, $50,000 in there this year, I get a $50,000 deduction off my income for this year. The money doesn't necessarily have to be donated to any charities right now. It could be left in there until we pass away and then be given to charities. It can be given to the charities, dripping it out to them, say 5% a year, every year to my charities, so that the foundation goes on for a long period of time. But you get the tax deduction now, and then now all the charities have to be tax deductible charities. That makes this. Some people, we have people that have, some of these are huge. We have a client that has one that's $5 million, and when they pass away, they have it already set up that these say 10 charities are going to each get a certain amount of money every year, and the total distribution from the charitable foundation account that they have is only going to be 5% per year. So it'll go on every year. Probably won't run out of money. And those charities will always get a check, and every year. And that's in some ways can be considered to be a better way of leaving money to charities or to a church than giving them a big chunk of money that they're probably going to not remember. Well, they might just spend the money anyway. That many charities or churches might be better off getting a check for $20,000 or $50,000 every year from if it was that big, than a big chunk of money all at once. But that's a neat strategy. If that's something that you're interested in, you can give us a call or send us an email or come in, and we can sit down and explain more about it to you, as well as any of these other strategies. We'll explain more if you have questions or want to talk about it.
All right. So
strategy number 4, this is mine. It's in the blue, isn't it?
Mm-hmm.
Yeah. Strategy number 4 is gifting cash to loved ones. A lot of times people, we have a number of clients that, they're realizing, especially as they get older, I just soon give my kids some money or my grandkids some money now, rather than wait for them to inherit it when I pass away. They'd rather have it now than wait whatever 10 or 20 years to when I pass away. So this is the idea of giving while you're living. Now you may or may not have heard of a thing called an annual gift exclusion. Currently it's $16,000 per person. You can gift up to $16,000 per person before the gift tax applies. Well, and then that's going to raise to $17,000 next year in 2023. But it doesn't really apply to most people. And the reason I say that is because the gift tax and the estate tax are tied together. And so if you gift more than the allowable amount to a person, let's say instead of gifting them $16,000, you gift them $100,000, the excess over 16 is just used to reduce your future estate tax exemption, the amount that you can leave your family free of federal estate tax. Well, right now, that's $12 million estate tax exemption, a little over 12 million. And for a couple, it's 24 million. So for most people, most of our clients, it's not going to have an effect. Also, that's per person, 16,000 per person. So, it could be grandkids, it could be a couple. If you wanted to gift your son and daughter-in-law, you could gift them 16,000 times 2. So the last thing I want to mention about this is that doesn't include charitable gifts at all. That's just to people. But if that's something that you want more information on, just let us know, send us an email or call us or come in. We'd love to help you. So what's strategy number 5, Jess?
Strategy number 5, the last one, is about leaving a legacy, and that one is gifting appreciated assets at death. And so when we're talking about appreciated assets, things that we're talking about are things like investment accounts, real estate, property, farmland, things like that, things that you bought at a certain price and now they're worth a lot more money than what you bought them for. And
if you sell them, you're going to have to pay capital gains tax on the gain.
Right. Now, if you decide that you want to gift things like that to your loved ones while you're alive, what happens is You gift it over and they get the same cost basis that you have, meaning their cost basis is what you bought the asset for,
So
basically.
let's use an example of a farm. Is that okay?
Sure.
So let's say you bought a farm a long time ago for $50,000 and now that farm is worth $250,000. If you gift that farm over to one of your children, or for instance, their cost basis on that farm when they down the road sell it, or somebody sells it down the road, the cost basis is locked in at $50,000. And so if you gift it to them and then after you pass away, or and then you die, and it's worth $250,000, they got to pay capital gains taxes on the $200,000 worth of gain. If instead you gift that farm to them when you pass away at your death, their cost basis is the value at your death, which, like right now in my example, would be $250,000. If they turn around and sell it right away for the value, they pay no tax. If they hold it for a while, long time maybe, and it grows from 250 to 300,000, they only got to pay the gain from 250 to 300, not have that low cost basis of $50,000. So it's a really important thing to think about if you're thinking about gifting an appreciated asset. Same thing would apply for a stock or a house or land like we're talking about.
So to summarize our 5 strategies, the first one is qualified charitable distributions from your IRA, directly from your IRA to a charity or a nonprofit.
The second one is making a charity the beneficiary of your IRA, because the charities don't have to pay taxes on it and your kids would. So you want your kids to pay as the minimal amount of taxes as possible. That would, and if you wanted to leave some money to a charity, rather than leave it in your will or trust to go to a charity, you would have the beneficiary of your IRA be a named charity. It doesn't have to be for the whole IRA. It could be for $10,000 or 10% or whatever you wanted it to be.
The third one is donor advised funds.
And donor advised funds are, like I said, where you set up an account and you make a distribution, or a contribution into it that you get to deduct this year. And down the road, it can start making charitable contributions out of there. The fourth one is gifting cash to loved ones. We talked about the limits to that and the rules regarding that, but basically for most people, you can gift whatever you want to a loved one, and it's not going to, don't worry about that 16 or next year $17,000 limit. That can be taken care of because it's tied into the estate tax exemption.
And the last one is gifting appreciated assets upon your death so that the cost basis is stepped up to your loved ones.
Yeah. So anyway, we doesn't look like we have any questions, but if anybody has any questions, please call our office at 402-421-2626 or email us at bob@bobbenny.com or
Jesse@bobbenny.com.
and we'd love to answer your questions. We just want to help you. We help people in all kinds of ways, not only with helping manage their investments, but helping people with estate plans, helping people with tax strategies, helping figure out how to set up retirement income and analyze the best way of taking Social Security and that sort of thing. Our goal is just to help as many people as we can. If you have a friend or a relative or anybody that would like this information, we can sure either meet with them or send them this webinar, and just let us know.
Thank you very much.
Have a happy Thanksgiving in a couple weeks.